You're listening to the Cash Flow Academy podcast with Andy Tanner, your source for investing made easy. Here's Andy Tanner.
Welcome to the Cash Flow Academy podcast. This is where investing is made simple. I'm your host, Andy Tanner. We're going to have a very important discussion on fees and economies and middleman and and efficiencies. It's going to be a great episode. It's something I think a lot about, and so I'm very grateful for our guest. Her name is Catherine Judge, law professor, author, financial regulation expert, and like my wife, mother of two. So a lot of fun. Kate joined the faculty at Columbia Law School in 2010. And her CV is endless. So we're really happy to have you, Catherine. Do you prefer Catherine or Kate?
Either, but Kate is great.
Okay, cool. Kate is good. You're a poet and didn't know it. Kate is great. So the book is very important. We're going to talk a little bit about eliminating. And it was Ayn Rand, I think, that said something to the effect that the straightest distance, or the shortest distance between 2 points is a straight line. Middlemen make it kind of more like a pretzel, I think, was something like the quote. I'm probably misquoting Ayn Rand. But the book here is direct. The Rise of the Middleman Economy and the Power of Going to the Source. So with that, we thank you for being on the podcast. And would you mind just, I gave a little bit of your background, but perhaps tell me what brought you to the point to want to write this particular book.
Yeah, so really I came to it through banking and finance. I am a law professor, and most of my focus traditionally has been on financial regulation. So I really got into the field and was motivated by a lot of what happened during the financial crisis. Mm-hmm. And what we saw in the decades leading up to the crisis, there was incredible innovation that really changed the nature of finance. We went from having a bank-based system where we had 16,000 community banks throughout the country that were relatively small and really used relationships to take in deposits and then make loans in their community. They took risks making loans to small businesses because they were really building a relationship that they hoped to profit from down the line if the business was successful. And then for a variety of different reasons, technology, changes in regulation, and other shifts, we really shifted to a place where the largest four banks, or six banks, depending on how you want to look at it, mm-hmm. control an outsized share of all of the banking assets in the system. And they had a different way of doing banking. They used a lot of technology and models. And so they said, look, we don't need these relationships. We can make soft information hard thanks to technology. And that, in turn, enabled a standardization or a seeming standardization of loan making, leading to securitization. So suddenly you had money flowing from Asia and Europe into U.S. homes. And for a while it worked great. We had a lot more home loans being made. Home ownership was at the peak. And then, of course, the other shoe dropped. And going back to your point about Ayn Rand, part of what we realized is markets are supposed to generate information, but actually the complexity of the system created massive information gaps. And so neither market participants nor regulators had the information they thought they did. Once there was a correction in housing prices, the dysfunction really built in ways that caused significant pain to the economy. And what Direct explores is the way we've seen similar patterns in so many other sectors of the economy. So if we think about food, if we think about retail, if we think about healthcare, we've actually had a proliferation of both these very large intermediaries, these large middlemen, and oftentimes that has fed and been fed by longer and complex supply chains. And very often you get short-term efficiencies, some very real gains, but there's also a lot of fragility, a lot of information loss, and a lot of problems that people aren't paying attention to when they're initially opting into these systems.
We'll talk about these middlemen and supply chain, particularly economic supply chain. Financial supply chain is in the cases you cited with the big crash. Let's talk about why we have these. If there's problems with them, obviously, for some reason, we said, well, here's a problem. We need someone to solve it, right? It reminds me of, this is a horrible metaphor, but it's the only one that comes to mind. We decide instead of taking the stairs to have an elevator. And my word, instead of having these poor new people, turn the handle themselves, we have a person in the elevator to make sure that we got to have this person in here because people won't know how to do it themselves, right? So there had to be some upside or perceived upside of bringing in what we're calling, middlemen. What's the upside? Why did we start expanding this pretzel instead of the 2 points?
Yeah, so in the short term, the upside is oftentimes quite significant, and that is the intermediaries appear to very often create efficiencies and to make our life easier. And this happens in different ways in different domains. I mean, a lot of your listeners are investors, and you can think of something like the New York Stock Exchange as providing this great structure and brokerage, which originally is, controlled by by the brokerage companies. By bringing people together who wanted to buy or sell stock, you could create liquidity and you could create a more efficient system for transacting in a whole variety of different goods because you would have this middleman who really developed expertise, developed relationships both among the consumers and the creators, and then oftentimes really built very valuable infrastructure that facilitated both the flow of information and the flow of goods in ways that made transacting easier. So in the short run, there's very often significant gains. And what I discovered when looking in this domain after domain is initially middlemen very often arise because they really are providing genuinely valuable service, overcoming those logistical and informational challenges in ways that are very valuable. And the challenges that often arise over time as those same attributes can allow them to actually distort the evolution of the market.
So I think this is a very important point in our conversation. And so for our listeners, I'd encourage them to perk up their ears because as the investor or as the entrepreneur, both, there's decisions to be made. And one of the decisions is, for example, as an entrepreneur, we say, do we hire this person? As we move from, you mentioned positives, as we move from being maybe a self-employed person that kind of the business owns them instead of them owning the business, how do we create economies? What people and systems do we need to bring in to make ourselves be able to grow, make more money, go faster? And so to become more efficient and larger, almost always involves becoming bigger, almost always. And then you get to a point where you might grow a little bit and say, boy, we're really heavy in this area and light in this area. So what I'm getting at is simply this. I love this idea of following the fees. Because as an investor, you might not be growing as a business. For example, in the case of the 401k, there's your employer, and you're tapped into Wall Street in a certain way, a lot of fees there. So can you talk about, how do I tell, beyond following fees or with following fees, how do we tell when something, part of a supply chain or part of a process is valuable to me or not?
A couple things there. So first, follow the fees is one of the core takeaways, is that we're not going to get a world without middlemen. We don't want a world without middlemen, but we need to become more sophisticated in navigating the middlemen that populate our lives as entrepreneurs, as investors, as consumers. And one is to really understand the business model of the intermediaries, the middlemen that you're relying on. And I have to say, my very first job out of college, I was a stockbroker at Merrill Lynch. I was a associate financial consultant, is what they called it back in the day. And that experience played a very significant role helping me understand both the benefits and oftentimes the more hidden drawbacks of relying on intermediaries and advisors in different aspects of your life. So what we saw then, or what I saw then, were very often my colleagues did a great job helping investors understand the importance of kind of saving for retirement, saving for their kids' college, of helping them to understand the benefits of diversification, helping them translate those long-term goals into the rate of savings that they needed. And so there was a lot of value that was created there because there was an alignment of interest. The challenge that started to arise was in how those funds were allocated. And really, as an investor, to overly simplify, very often if you're working with financial planner or stockbroker, you're making a choice. And so one might be you have to pay a pretty big upfront fee for somebody who's going to come up with a financial plan that's going to help you figure out, well, what are the ideal ways to allocate my resources given my long-term goals and my particular risk aversion. And the second is somebody who's really nice and smiles a lot and says, look, I'm going to help you out for free. You don't, like, they don't say free, but, you don't pay anything out of pocket. Yeah. Suddenly you have this person who's really helping you provide an idea of what you need long term. But guess what? They're going to make a bunch of recommendations about investments that are going to reflect their interest based on how much they're going to get paid by virtue of the investments that you make. Yeah. And so one of the key ideas in Follow the Fees, and this shifts into the lessons for entrepreneurs, is very often in the short run, it's cheaper and easier to rely on the person that seems free, and it's also cheaper and easier, it seems, to rely on an intermediary rather than doing the heavy lifting yourself. But oftentimes there's going to be hidden long-term costs in that.
Very much so.
And that also happens for entrepreneurs. And so if you're thinking about, okay, well, do I want to sell directly to my customers? That requires a lot of work. So very often you're relying on an intermediary or layers of intermediaries to do those sales for you. And there's a lot of benefits to that model. And you can have a retail store, for example, that helps to sell your good or rely on others to help advertise your services. But then they're getting the information about what people want. They're getting to tell your story, or they're not telling your story. And so one of the aspects of direct that I look at is a number of companies, oftentimes family-owned or kind of the more VC-backed direct-to-consumer, where they're really able to control the consumer relationship in a different way. And when you're thinking upstream, again, you can really start to understand what are your vulnerabilities. And one of the challenges we've seen with all the supply chain shocks over the last couple of years is not only that there were vulnerabilities, but oftentimes entrepreneurs and companies had not spent time understanding those vulnerabilities. They outsourced without realizing the risks that they were taking. And so a lot of this is just thinking rigorously about middlemen, about intermediation design in our individual lives and our professional lives allows us to make more sophisticated and better long-term decisions that really serve our interests.
The reason this is so important, and I don't know that the average person wakes up in the morning and over their morning coffee, they're like, man, I wonder what I should learn about supply chain today, right? This is a very narrow focused, and yet for those that understand, absolutely essential. So here's an interesting experience that anyone, even in a small business, I think a person experiences this. As we bring people into a system of supply, there's also a dependence that's created. This might be a great time to talk about the rumblings I'm hearing with the railroads a little bit. Is we say, well, how can we be more efficient in getting this, this commodity, whatever it may be, corn, soybeans, coal. How can we get this commodity from point A to point? Oh, let's get a rail system. Well, now we're dependent, and that's better than maybe a truck system, right? Or, horse and buggy, obviously. But whatever one we choose, we're now dependent. I mean, a middleman, I don't want to use the word counterparty risk, but that's the one that comes to mind. How does that work? How does that play into the scenario where we have tremendous dependence now? When COVID was I think COVID was a wonderful opportunity for us to learn so many things sociologically, economically, on so many levels. It was almost like it was a really bad experiment, but yet the good that would come out of it is we can learn so much, particularly in the idea of physical supply chains with commodities and the inflation and the dependence we had. Not to make the question too rambling or long, but my grandmother and even my mother, they had a garden. They had a cow. They had chickens. They had eggs. They had certainly to go to the grocery store for some things, but they were, very much self-reliant in the days of the Great Depression, where now when we have something like this happen, I feel we're much more dependent on supply chain. Can you talk about dependence and the risks when it gets clogged up? I know it's a long
great way of
question.
framing it. And again, all four of my grandparents grew up on farms during the Great Depression, and it is really interesting. One of the things I track in the book is the evolution of farming and the rise of Cargill. It really is being the company that created for a while more billionaires than any other company in the world. There were 14 billionaires for a while that came out of Cargill. And it's changed the nature of farming, and it also has changed the nature of what it means to be a consumer.
Yeah.
And as you pointed out, during COVID, we suddenly went to the grocery store, and we always assumed there was going to be food there, and suddenly we saw bare shelves. And so it did illuminate vulnerabilities and dependencies that had been there all along, but when our needs were satisfied, we weren't attuned to them. And we're seeing that now with medical dyes, with formula shortages, that we really are reliant on a globalized system that's more fragile than we appreciated. And then that really does also come home for entrepreneurs and for investors of thinking more strategically and, again, more long-term about, well, what does it mean to become reliant on a particular intermediary, either upstream or downstream, and what are the risks associated with it? Which doesn't mean that it might not be the right decision. But, for example, we're seeing that right now for a lot of small businesses that turned to Amazon and felt they had to turn to Amazon as an intermediary through which they were reaching different buyers. And again, one of the things we know is a lot of people are Prime members. And at this point, the average person who regularly shops online starts their search for a good at Amazon.
Yep.
They don't search at Google or another search engine. They start at Amazon. So you feel like you have to be there.
Yeah.
But there's been some really great work done that even as consumers continue to flock to Amazon and feel like they're oftentimes having a good experience and trusting Amazon, and Amazon has built this absolutely amazing delivery infrastructure.
Yeah.
The cut they are taking on each sale has gone up each and every year for the past 8 years.
Well,
and it's oftentimes by, seeming to offer additional services like, okay, we'll put it in the warehouse, we're going to offer you advertising. But really, buyers become so reliant on Amazon that they need to continue to buy these additional services. And so suddenly the volume of their sales are going up. But the cut that they are taking is going smaller. And one of the challenges is they don't have a lot of leverage to say, look, we're just not going to take it, we're going to opt out. And so, first of all, for the entrepreneur, it means thinking long-term, not just, is this platform going to help me reach my customers today, but if I only use that platform, as opposed to developing multiple different channels, how might that platform potentially change their rules or change their fee structures in ways that might undermine my business, so this thing that I've spent years building up is no longer profitable a couple of years down the line. And then from a policy perspective, thinking about, well, how do we create the infrastructure so consumers and creators have the ability to opt out when they want to? And that's a lot of the interesting policy issues that I think are right now at play.
I tell you, now, don't push a button on the host on Amazon. As someone who's written a couple of books and sold them on Amazon, it's been a great blessing on the one side because you get exposure. But generally, I think it's been the practice of people to raise the amount, to renegotiate what they feel their cut should be, maybe yearly. They started doing it quarterly, and the amount of money they were taking was just unbelievable. So that's something I've experienced firsthand, and yet you do get the exposure. So interesting stuff. Now here is a really, this is, kind of saving the best for the second half of what we're doing here. Because I very much want your take on this. When our producers were fortunate enough to reach out to you, and you were kind enough to accept the invitation to be on the show, this is where my mind went first. DeFi, decentralized finance. Yeah. This is not something that a lot of people, well, I suppose I'll say the majority of people, there's a lot of people all over DeFi. And this feels like a new emergence, and maybe this is another poor metaphor. But I think people should really go back to 1993. Those of us that were alive then, if you weren't alive then, read about it. Is all of a sudden our vocabulary changed, and we had this thing called Netscape. And Netscape was really the first major, widely accepted browser, right? It's not around much anymore. You don't see it much anymore. But people say, yeah, I'm going to get on Netscape and do this, right? That's what the web was. It was Netscape. And all of a sudden, if you're a travel agent, you're in trouble, because now I can go right to Delta Airlines and I can do this much more efficiently. In the same time it takes me to call a travel agent on the phone and have that travel agent, book my travel and do all this, I could have had it done online. And so we eliminated, I wouldn't say we extinguished an industry, but we drastically reduced the amount of people that we had to deal with because technology was disruptive to them, and it was just easier to book it yourself. And shoot, we'll get probably to the point where Alexa will book the trip if we're not there already. So now we have DeFi, and I'll tell you, I see no reason for a New York Stock Exchange anymore. I really don't. I see no reason for a bank anymore, but we're going to depend on algorithms now. If a bank isn't going to run their algorithms to find out who is worthy of a loan and what their credit might be, well, we'll be dependent on an algorithm to do that if we want to be a loaner or a borrower. But can you comment on, I think that's the big conversation, is the possibilities of DeFi. What do you think? What is DeFi? When I talk about decentralized finance, what does that mean to you? Is it a thing, or is it a hope, or is it absolutely the future?
At this point, DeFi, I believe, is aspirational. There's a lot of areas where people claim that we are already in a world of decentralized finance. But very often, if you look at that actual entire ecosystem very closely, there's still a lot of intermediaries making a heck of a lot of money off of the activity that happens in those domains. And that goes back in some ways to your follow the fees point, is you want to look past the heading and actually look at, well, who's involved and why are they involved and where might they be making money. But your point about technology is absolutely central. And this is one of the core conundrums that we confront in domain after domain, because you're right. I mean, if we look at what happened with the internet, travel agents have been an absolutely critical middleman. They really don't exist anymore. They exist, but in a much more niche way. Yeah. And that has created a much better system in most regards. But what's interesting, going back to what you're talking about in the mid-'90s, is it wasn't just travel agents that were supposed to be disrupted. It was middlemen of all sorts. And so we have these incredibly hopeful statements from Bill Gates and others suggesting the rise of the internet is going to eliminate the need for banks, that we need bank services, but we don't need banks, so we don't need middlemen of all sorts. And yet, going back to the conversation we just had, one of the things that we've actually seen over the past 25 years has not been a reduction in the significance of intermediaries, but a growing power on the part of many intermediaries. So in so many different domains, go back to retail, Amazon is where we start, and they actually have more influence in many regards over what people are buying and how they're buying it than we did in the brick and mortar era. So of course Walmart was pretty big as well. And we think about something like real estate. Mm-hmm. You can go on to Redfin, and it seems like so easy. It seems like you have so much more control than you did back when you were relying on a real estate agent to show you some listings. And yet, in the United States, the buyer and seller typically still have pretty something close to a full-service real estate agent. And collectively, those agents are still earning, on average, 5% of the sale of every home in the country.
Yeah.
And so what we've seen, even though we have technology that should disrupt the need and has changed the role that they play, intermediaries have managed to find a way to stay relevant. And so that's where I think we really need to think critically. First, there's going to be times where they're playing roles that we don't realize. And one of the examples the book goes through is peer-to-peer lending, which has really evolved to marketplace lending, where it is algorithms, but it's algorithms controlled by intermediaries. And well, what was that evolution? And what were the critical roles that intermediaries were playing that people didn't fully appreciate? Which is, again, why this is not just saying that these are bad, but there can be some good coming from it. But it's also understanding that intermediaries can keep themselves entrenched even when we don't really want them to or need them to. Yep. Because they have such incredible tools at their disposal. And that's where becoming more discriminating. And like you said, nobody wakes up and says, I want to think about intermediation today. I want to think about middlemen. But if you're waking up and you're looking at your breakfast cereal, odds are you don't know much about the people or the places behind the grain that was actually grown. I mean, I remember trying to call Cheerios, and they just wouldn't actually tell me where they source their oats. We really are incredibly reliant on them in ways that are great, but also create vulnerabilities and challenges. And what we've really seen with technology is it cuts both ways. It very often reduces the need for a middleman. There's ways to connect directly. You can self-publish a book today, and yet we see publishing companies, and I had a great one, still playing an absolutely central role determining what books people actually read. And similarly, I think in a lot of the online environment and the financial system. And so part of it is really trying to understand, well, what are the roles that are being played here? What do we need? What don't we need? And recognize it can be a moving target, but that we're not going to automatically shift to disruption, even when that's possible. And sometimes it's because they're playing valuable roles we hadn't appreciated, and sometimes actually they're not playing roles that are all that valuable. They just know how to contort the law and market structures in ways that help them to entrench what might be a high fee and outdated mode of doing things. And again, I'd say data is the other part of the key here when we're thinking about technology. And very often, access and control to data is one of the factors that can really help large middlemen continue to play an outsized role.
The book we're discussing, authored by Catherine Judge, is Direct: The Rise of the Middleman Economy and the Power of Going to the Source. The most important takeaway, I hope people, and I'm a broken record, it's no secret, our listeners are, I think we're a family of education advocates. I think the reason we have the number of people we do that tune in, not everybody, but we have a really solid audience that cares about getting better, that they want to learn things. I hope that while our podcast is enjoyable to listen to, we hope it'd be more edutainment than entertainment. And I'm going to read one of my favorite quotes from Warren Buffett, and this draws a line in the sand for every person. It's not a very well-known quote from Warren. You've got diversification quotes and, be fearful when people are greedy and vice versa. But this is one that really, this draws a line in the sand. He says, the ultimate irony of the investment business is that there is no question that an obstetrician can deliver babies better than a husband and wife. If you take dentists as a whole, they will pull teeth or fill teeth better than if the patients try to do it themselves. But in the investment world, someone who believes in American business and is consistent will get the results that exceed the professionals as a group. Now, this is educational. And part of a person's education is to begin to determine what are my life skills and what are my skills for hire. What are the things I'm going to do and not let go of? And, am I going to drive my car or hire a chauffeur? Am I going to learn to brush my teeth or have someone else do it? I'm going to learn to tie my shoes. So the question is investing a life skill? And the common denominator that I don't think people can eliminate is learning. I don't think we can automate that process to the degree people would want to, and here's why. You mentioned earlier, it was interesting you brought up that, I don't know much about investing, so I'm going to go to a financial advisor. And a person doesn't even know if that plan is going to be a function of their balance sheet, where they're going to try and build a lot of net worth that is basically an hourglass, that the day you transition from working to retirement, if you're going to sell off those assets, you've got an hourglass, and you got to look in the mirror and say, well, can I afford to retire right now, or do I got to keep working for a few more years? Or you might not even realize that you could make your retirement plan a function of the income statement, where you said, no, I'm not going to worry about my net worth so much, but I'm going to build active cash flow with the investments I invest in. I'm really going to care about building income, generating assets rather than assets that appreciate. This brings us to crypto. Everyone's talking about crypto. Okay, how do you make money on crypto, right? That's not a cash flowing asset unless you're a middleman charging gas fees, or you're a producer, mining this stuff. Obsolescence risk. So the reason I recommend Direct the rise of the middleman economy and the power of going to the source is the importance of understanding education. That when we go in school, you say, well, we're going to dissect this frog. Why? Well, it's just part of what you ought to know. Once you get out of school, education, the hierarchy of it, whether it's interesting, vital, trivial, is something you make the decision on. Could you speak, Catherine, to the importance or unimportance? I mean, maybe I'm wrong, but I think people reading books like yours and learning faster and more as technology grows and decentralization happens, how important is it for people to study the direct economy?
I think it's incredibly important. And part of what it's highlighting is not just the direct economy, but understanding the two different extremes, the hyper-intermediate world that we currently inhabit, and direct is this opposite extreme that many of us actually experience on occasion, but maybe not in a way where we've been thoughtful, but well, what are the differences between these two different extremes, and what are the trade-offs we're making without making it, really gives you a new set of tools for understanding the world that you inhabit. And I love your point about education. And part of it is not just that you need to keep learning, but it's a question of what is it you need to learn to better live the life that you want to lead. And, we've had a great swath of books for a long time looking at behavioral economics and social psychology and kind of learning your own biases so you can help to overcome them and make better decisions. But there's a lot that we also need to learn about the incentives and infrastructure of the world that we're inhabiting that shapes the options that we see, it shapes the options that we don't see. And, well, what are the incentives of those who are creating those decision environments and the other environments where we're spending time, both online and in real life? And so a lot of what Direct is trying to do is to empower readers, not to say, like, you need to go a particular direction, but to really empower them by giving the tools they need to see what might be intentionally hidden from view, either right now or in the future, in ways that enable, again, individuals, but also really entrepreneurs and businesses to make better decisions. And I think understanding the trade-offs. And you're right, with Amazon or any of these others, it's not that there's a right or wrong, it's that there's trade-offs. And understanding those trade-offs and where do the different circumstances where you might realize the benefits or might the cost really come back to bite, really just helps you to make much more informed decisions that reflect your, again, personal needs, preferences, biases, capabilities, and we're all individual. So the book gives you a bunch of principles. It doesn't give rules because I don't think there's a cookie-cutter solution, but instead it gives principles that not only invite but really require you to bring some self-knowledge to the table of your business model or what your preferences are as an individual that then you can use to help maximize whatever it is you're trying to achieve.
Yeah, I don't know. I don't think I'm very good at coining terms, but one of the terms I talk about, and maybe I didn't coin it, but I love the term ignorance fee. Because if I don't understand how a system works, and you talk about follow the fees, when we don't understand what's going on and we begin to get lazy intellectually, we get lazy educationally, that's when people can charge you for the stuff you don't understand. And I think Wall Street's a great example of that in the 401k. They've had to come a little bit off of their high horse on the fees, especially in the early 2000s, late 90s. The fees they were charging were, they have a profit motive. And if a person doesn't understand a system and doesn't understand how something works they don't have the education, it will cost you. It will cost you. What won't cost you a lot of money is to go to Amazon and get Direct. The rise of the middleman economy and the power of going to the source. It's, we do a podcast about every 2 weeks, and it's the perfect amount of time to not just be able to read and add to our education, but digest what each and every author we bring on. And I just think this is an unnoticed gem of it's a wonderful topic that isn't written about well. This fills a wonderful space in my opinion. So so much to learn, so much in the world is changing. And if you want to protect yourself and survive supply chain issues and you want to thrive, follow these principles that Catherine has given to us. Let's close with this idea. The future is really interesting in that one of the things we learned from COVID is globalization is certainly deflationary, and localization is inflationary. Mostly because of labor. People around the world have different standards for what they want to take home at the end of the day, and obviously there's a lot of people in China competing for work, and so generally they will, and the nature of their culture and their politics enables them to produce things at much less cost than, say, what people in my home country, the United States, would demand. So globalization is deflationary, but when those supply chains are choked, it's inflationary. As we look at those lessons, if you're an investor or you're an entrepreneur or you're a consumer, what would you tell people about the future? What should they learn? What should they do to, in any of those three, to prepare for what may or may not happen next?
I think a lot of it is grappling with what you just said, which is there's a lot of uncertainty out there, and I think it's going to increase. It started perhaps with the '08 crisis. We certainly saw it during the pandemic. We're seeing it with the geopolitical challenges that are currently arising and oftentimes focused on Russia's invasion of Ukraine, but we're also seeing real tensions with China. And so what that really means is that to be successful, whatever that might mean for you, you need to be able to operate in an uncertain and evolving environment. And that doesn't mean having all the answers, but it does mean being mindful of the risks that you're taking on, perhaps without even realizing that you're taking a risk. You mentioned counterparty risk earlier, and I do think it's thinking much more broadly. And risk means, again, merely variance. So it's downside, but also upside. There's going to also be a lot of opportunity. Being more sophisticated in not just looking at the environment in which you're operating, but attuned to the shocks that could occur domestically or internationally and in so many different forms. And then being a little bit more strategic to try to build in some resilience so that whether it's your business or whether it's your investment portfolio, you can keep operating and continue to get maybe not the returns or the outcomes that you would initially hope for, but ones that are still within the range of what's acceptable for you in the event of bad things happening. And so a lot of our direct does is just help us to illuminate how much we're just not seeing that actually exposes us to risks because of because we just we engage with all these middlemen and we don't see beyond that. And spending a little time thinking in a more rigorous way about what's beyond that, it can help if you care about things like ESG or sustainability to actually make those decisions in a much more informed way when you're thinking rigorously about intermediation. But I also think it really is critical right now for businesses and the survival of new businesses to think about, okay, well, where can I get credit today? But also, is that going to be a reliant source of credit in the future? And one of the differences between bank and non-banks. And so really understanding and taking a little more time to not only look at what's expedient or efficient right at the moment, but understanding, well, what are the risks I might be taking on? So not forever. You don't want to be frozen, but a little more time to be mindful of those risks and to make decisions with an eye to them. And thinking really about what you're not seeing along with what you are seeing, I think can pay significant dividends in making sure that whatever the trajectory looks like, whether it's exactly the best case scenario or you're in a second or third best world, that even that second or third best is still within the range of something that really feels good, as opposed to really being taken out by surprise.
This is fantastic education, a wonderful opportunity. Catherine's website is Catherine Judge, and that's spelled with a Y, KathrynJudge.com. And on her website, if you click on the link for the book, you have various supply chains to choose from. We have Apple Books and Google Pay and Amazon, Barnes & Noble, and others. So you can choose how you'd like that to be delivered to your door or electronic device. Catherine, thank you so much you're just delightful, and your insights are fantastic. It's we're all so lucky that by putting in our earbuds and taking a little time for a podcast, we can tap into the knowledge of so many people. I can't imagine what people 100 years ago would think about our ability to simply click a button, have great books delivered, have great previews like this given to us so we can decide what we want to learn. You've been listening to Catherine Judge, author of Direct, The Rise of the Middleman Economy and the Power of Going to the Source. Her website is catherinejudge.com. I hope you enjoyed our conversation. This is Andy Tanner, your host. This is where we try our very best to make investing simple. We'll see you next time.
You've been listening to the Cash Flow Academy podcast with Andy Tanner. For more information on investing made easy, go to thecashflowacademy.com.